Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Neena Mishra.
Hello and welcome to ETF Spotlight. I'm your host Neena Mishra. My guest today is Matt Bartolini, Managing Director and Global Head of Research Strategists at State Street Investment Management. And we are talking about the market outlook and the best investing strategies for 2026. And obviously, with 2025 almost in the rearview mirror, the big question for investors is whether stocks will continue to march higher after 3 years of blockbuster gains. So obviously very excited to talk about the 2026 outlook. Matt, welcome back. Thanks for joining us.
Yeah, thanks for having me. Excited to be back on.
Most Wall Street bank pundits, they expect US stocks to post another year of double-digit gains in 2026. And State Street, released your 2026 outlook recently, which is described as uncomfortably bullish. So we'll talk about the uncomfortable part a little later. Let's start with the bullish part. What is driving this optimism for 2026?
Yeah, I think the optimism stems from a couple different factors. If we take a step back and just look at the macro landscape. So you have a monetary impulse that is likely to be positive, given the fact that the Federal Reserve has lowered rates now 3 times in 2025, and there's been roughly a cumulative 175 basis points of cuts over the last 18 months. And there's research from the Federal Reserve Bank of Atlanta that showcases that particularly it takes about 18 months to 2 years for the full effects of monetary policy to make its way through the economy. So I think in 2026, those prior actions, irrespective of anything the Fed does in 2026 in terms of their own rate policy, the prior actions start to really impact the economy in a meaningful way. So that'll offer a monetary policy impulse and be beneficial to growth. At the same time, you have fiscal impulses with respect to the One Big Beautiful Bill Act coming online and their tax incentives and refunds, providing that boost to the consumer in terms of no taxes on tip, tax on overtime, the revised state and local tax, the SALT tax, in addition to incentives to companies in terms of changing the maximum amount of deductible business expense from EBIT to EBITDA, and then the research and development immediate expensing. So those policies are going to be coming online in 2026, and that can be a benefit to both consumer and company and be growth positive. So those two factors alone sort of signal some optimism for just economic and fundamental growth beyond the continued capital expenditures from the AI hyperscalers, where that spending will also likely start to flow down into the economy as well, into those AI adjacent areas and the infrastructure perspective, utilities and electricity build out as well. So there's more biases to the upside from a growth perspective that signal positivity for risk assets like equities, like U.S. equities, to continue to have positive returns. And I think for the U.S., if you look at it in the large cap space, you have roughly projected 14% earnings per share growth. And I think there's no question that valuations are priced high, right? So more price for perfection, where there's probably not going to be a lot of multiple expansion taking place in 2026. But if that's the base case and returns mainly come from growth and earnings per share growth in 2026 is roughly 14%, that's double-digit growth and potentially double-digit returns. So you can definitely see the underpinnings of optimism, and that's where that bullishness does come into fruition.
Let's talk about the uncomfortable part now. What are the risks ahead that investors should be aware of? Because it does mention that even with all this solid backing in place, investors still need to contend with some developing headwinds.
Yeah, I mean, I think in some respects, those impulses, both on a monetary and fiscal side, offer the upside for growth, but also do create some concerns. The concerns is that they'll be inflationary. They'll fuel inflationary spirits as a result of that, and that could be detrimental to affordability and to the consumer who could have to pay higher prices for basic necessities at a time where labor dynamics are shifting in a way that is coming off of some low points in unemployment, where it could be a concern. I think you also have this shift towards more state capitalism, and that could also create uncertainty in the forward trajectory of again, job growth, national security, trade tensions. I think it goes without saying that while the original trade discussions and trade actions were more benign than the original forecasts, we are still not in an environment without trade uncertainty. So that does create some uncomfortableness because it could impact negatively both headline sentiment, like we saw during Liberation Day, but also be a headwind for overall economic growth. And I think the last part is, if we just take a look at where most portfolios are allocated, and I think that is some of the more uncomfortableness too, but where allocations lie. But if you look at the S&P 500, you do have valuations that are significantly stretched. And that does mean they are priced for somewhat of perfection, like I said earlier, and that the margin of error is slim, and that you do not have this significant amount of a fundamental safety net to mitigate short-term price volatility. So you're basically taking a look at the current price and extrapolating out sizable future growth. And that is also a reason to be uncomfortable, is that will we actually achieve those lofty growth expectations? And will AI deliver on that productivity miracle? And I think it's fair to say we still don't know who those winners and losers of AI are. So there is some uncomfortableness baked into these bullish forecasts.
Right. So lately we have seen some jitters over these massive spending plans on AI and also a potential AI bubble. And Oracle shares fell about 11% yesterday, and they are down today as well, and dragging all other AI beneficiaries down. And for reference, we are recording this on Friday, December 12th. And Oracle, as we know, has lately become a poster child for this AI spending angst. So I was interested in your thoughts on this potential AI bubble. Are we in an AI bubble?
So I think the only bubble we are in regards to AI is talking about an AI bubble. I think we do not have an actual bubble in AI. I think the bubble is still expanding. It is not contracting. And I think there's obviously a lot of corollaries back to the dot-com era, where you had this revolutionary technological innovation creating robust optimism for not only just the US economy, but the global economy. But the corollary to technological innovations kind of stops there. If you look at where a lot of the spending is being fueled from, it's being fueled from earnings, right? And the earnings and the cash flow. And earnings of these companies are expanding. They're expanding at a very high pace, and they're taking those earnings and investing them into the capital expenditures for AI. Now, there has been some debt raised to funnel this. I think that is something to keep an eye on, of how much debt is being needed to expand the spending. But I think right now, a lot of that spending has been on spending been driven by cash flow generation. The other one is looking at a catalyst. I think there isn't really this significant catalyst for a bubble to burst if there was one. Policy, like we said earlier, is loosening, not tightening. The Fed has been easing and still is forecasted to ease at least once more based on their dot plots. And so you do not have, elevated rates and financing costs to then sort of pop those bubbles and make that asset spending turn into unproductive assets because of the high relative cost. So Right now, we are still in those early days. We're in the early days of a CapEx cycle. At some point, there will be that focus on monetization. We are not there yet. And that's because we're still in the early days.
I agree with you totally. Now, let's talk about positioning the portfolios for 2026. And your piece recommends three themes: boost resilience with multi asset and alternative strategies, target AI and policy led growth from US to emerging markets, and then pursue bond upside with active short duration and credit. So I wanted to dive deeper into a couple of these, and starting with targeted AI and policy led growth, because we were just talking about AI, and we know that there is tremendous optimism about AI driven productivity gains, but also other important factors. Now, mega cap tech stocks have remained big winners in 2025 despite these recent jitters. And I was looking at the sector performance for 2025. Information technology and communication services are the top performing sectors for 2025. And these two sectors are dominated by AI and AI beneficiaries, all mega cap stocks. Lately, other areas are also doing well. We saw that the Russell 2000 index of small companies that reached a new high yesterday. Banks, particularly big banks, have been doing quite well. Healthcare stocks have been doing well. But US, equity market concentration, that is top of mind for investors. So do you recommend staying in areas that have worked for the past 3 years, which is growth stocks, mega cap tech stocks? And you talked about their earnings growth and also their stressed valuations, or you recommend rotating to other areas?
So I think there's a part of this where the winners and losers of AI have not been defined yet. And I think that's very similar to the dot-com era, right? There are corollaries you can draw. You can't, it's not one-to-one, no, for everything. So I think trying to have a broader exposure to the AI leaders currently can help diversify bulk when we actually get the final tally of who wins and who loses. So that's why, having that growth bias can help. But I do think when constructing, if you are constructing somewhat of an AI portfolio or trying to infuse more AI relevancy into your broader asset allocation within equities, for example, I think there's one area that can sort of serve two goals, and that's emerging markets. I think what we see from flows and asset positioning is that, and even just if you look at it in the market capitalization framework, where the US equity market makes up roughly 65 to 66% of overall capitalization, we see positioning, mainly in ETF land where US equity assets are, likely upwards of 80% of all equity assets. So there's a heavy bias just to own the US. And again, that could be spurred by AI, it could be spurred by, longer term performance trends. But I think you need to have balance. And I think that's one of the big things in our outlook is that even though we are uncomfortably bullish, right, or bullish, that uncomfortable nature of it means you need to sort of seek out balance across your assets. And we think emerging market equities can offer you this balance potentially, not only from a geographical diversification perspective, because many are underweight EM, but also from an AI relationship perspective. So, EM is AI. If you look at the underlying countries and who are, and who are innovating within AI as well, in terms of China and Taiwan and South Korea and India, there's different components there. And then you also just then have the macro element of EM too, where you do see really strong earnings growth potential coming from emerging markets. You have constructive relative valuations, you have tamer inflationary trends, and you have stronger economic growth as well. So I think in this type of market, having a bias or an overweight, or at least trying to get back to market weight in EM in your portfolio, can really offer you some balance in this type of market.
Right. International markets are pretty interesting because after many years of underperformance, they are beating the S&P 500 index this year. And even looking at the emerging markets, your emerging markets ETF, SPEM, I see that it is up about 22% year to date. Pretty impressive performance. And the factors that you mentioned, they are really interesting. Now, another theme that you mentioned is boosting resilience with multi-asset and alternative strategies. Tell us more.
Yeah, I mean, I think if we just, again, take a really big step back and try to levitate above all of these other, macro policy evolutions, we do see stubborn inflation with some potential upside risks to that because of all of the stimulus coming online and how it's been just really, really stubborn and slower moving down to the preferred goal that the Federal Reserve has. But there's also a shift in the global macroeconomic paradigm. We've seen this shift take place over the last 18 months where fiscal policy has definitely veered sharply away from traditional norms, where now, it's very often you see nations negotiating trade deals in public, you have courts weighing the legality of different measures and governments implementing trade protection policies at really breakneck speed. All these political dynamics are amplified by different changes too from an economic perspective. And the underlying theme is to build self-sufficiency and dial back global cooperation that a lot of equity allocations benefited up from over the last 15 years. And I think what we see is that you're continually seeing countries increasingly using supply chains and critical inputs like rare earths and energy and semiconductors as defensive tools to block competitors from gaining an edge. Artificial intelligence is obviously at the center of that. And I think the ripple effect here is that global economic activity and cash flows are turning increasingly inwards as nations embrace mercantilist policies to defend state-backed champions. And that can threaten and compress corporate margins and maybe be a deterrent to fundamental growth, as capital allocations are no longer just solely driven by profit maximization and operational efficiency. Instead, you now have decisions being made in favor of political expediency, I should say. And what that means is that investment flows may reflect more nationalist and national politic priorities rather than market logic. And that can drive up costs, fuel inflationary pressures, and really reverse that globalization trend that defined the 2010s. So all of that means is that when we look out at portfolios, what do you see? You see a lot of assets dedicated to equities, which like rising growth and subdued inflation, or nominal bonds, which like falling growth and subdued inflation. And so there's really not a lot of resiliency in that, because even in your 60-40 portfolio, the majority of your equity bucket is driving that risk. So we really think there are ways to boost resilience by using multi-asset strategies, by using more commodity-based strategies that have an upward bias to inflation. And I think it's because this new economy requires portfolios engineered for complexity, bridges that are built to span uncertainty, that are reinforced by diversification, and are essentially designed to thrive amid evolving fiscal policy, strategic rivalry, and persistent inflation. So it's definitely a reflection of how the world is continuously changing at a pretty sizable speed, and the sort of macroeconomic foundations that underpinned all of those gains from the equity concentrated portfolio over the last 15 years are unlikely to be there for the next 15 years, because that global macroeconomic paradigm has massively shifted.
Right. It's been a great year for some commodities. Gold has done so well. Lately, silver has been jumping to new record highs. Other metals, critical metals, also have been doing so well. So adding some of those alternative strategies to the portfolios, they make a lot of sense. Now, switching gears a little bit, let's talk about ETF flows, because it's been a blockbuster year for ETF flows as well. And you track ETF flows very closely. So tell us about your key takeaways from ETF flows.
So, I mean, the key takeaway is that ETFs they already broke records, and that they are likely to extend their run to about 1.4 trillion of overall flows in 2025. I think underneath that, there are some secular drivers with respect to low cost ETFs as well as active. Taken together, those two big areas have taken in roughly like 85% of all the flows. So there's really these secular growth engines that are going to be continuing to drive asset adoption, not just this year, but for the next 10, 20 years. I think up is the only way for ETF assets and flows, just given some of the benefits that the structure has. I think more tactically, what we have seen is that there has been some risk taking within sectors, following the depths of the drawdown around Liberation Day. After that, sectors have only had inflows. So they've had inflows for now. It would be the month of the year, or the month ended today, it would be 8 consecutive months of inflows. So there has been some risk taking, and there's been a little bit of a cyclical bias to it, with industrials doing quite well. But also, when we're looking at it on a sort of that cyclical versus defensives, defensives have inflows, but mainly from utilities, and utilities are connected to that AI trade, given their involvement in increasing the electricity capacity. I would say the other big trend is that there's been really no love for the long bond. So if we look at it and break it out by government bond ETF exposures by their maturity, that short to intermediate term segment of the market in 2025 has taken in roughly 90% of all government bond ETF flows. And I think what that sort of signifies or illustrates is that, investors are not really willing to take on that long duration risk, particularly given some of the things that we had talked about, where you do have the potential for upward bias of inflation risks, and you do have widening term premiums on the long end, and the potential for a steeper yield curve. And, that type of volatility to endure is really not attractive. So investors are really sort of trying to strike a balance and own that sort of intermediate and shorter end of the curve.
Very interesting trends. We'll have to leave it there, but thank you so much for joining us today and for sharing your insights.
Yeah, thank you for having me.
That was Matt Bartolini from State Street. Now let's talk a little bit about some ETFs that you could use to implement those ideas. So focusing on AI innovation, Communication Services ETF, ticker symbol XLC by State Street. That is worth a look because we know Communication Services is a leading adopter of AI, and valuations are not that stretched, whereas earnings growth remains very impressive. Then, if you want to capture AI leadership and growth broadening through US large cap growth, State Street offers SPYG, one of the cheapest in the space, with an expense ratio of just 4 basis points. Now, he mentioned utilities, which provide a distinct blend of defensive positioning and structural growth, which is driven by rising electricity demand. The most popular and one of the cheapest products in this space is by State Street, the Spider ETF XLU. Another ETF that I like in this space, if you prefer active management, is UTES, UTES. It's Virtus Reefs Utilities ETF. And in full disclosure, I own it in the ETF investor portfolio that I manage. This is pricier, but it has been able to outperform the broader sector by focusing more on AI beneficiaries within the utilities space. Now, we talked about emerging markets and their outperformance also flows into emerging markets ETFs. So State Street offers one of the cheapest ETFs in this space. Again, it is the Spider Portfolio Emerging Markets ETF SPEM, with an expense ratio of 7 basis points. The most popular product in this space is by iShares Core MSCI Emerging Markets ETF, ticker symbol IEMG, and this has an expense ratio of 9 basis points. We talked about boosting resilience with the multi-asset and alternative strategies. There are various ways you could do that. We discussed gold, and I have talked about gold ETFs many times. for long-term focused investors, GLDM and IAUM, GLDM by State Street and IAUM by BlackRock. Those are the cheapest physically backed gold ETFs and suitable for long-term focused investors. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcasts. Make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.